Hello, and thank you for joining us on this stock pitch presentation. Today we're going to talk about Air New Zealand, the well-known airline company in New Zealand and also around the globe, and our thoughts and researches about where the stock of this popular company is most possibly heading in the near future. Now, as you can see, our presentation consists of 4 parts. We're a team of 2 students. My name is Adam Lu, and I'll be talking about the first part, the investment thesis, and the last part, about the valuation of our stock pitch. And my teammate Chang, he will show you the specific overview of Air New Zealand and analyze the outlook of airline industry, which are included in the second and third parts. Okay, so we are here in the investment thesis part, which serves as a summary about our decision on the investment of the stock and the main reasons of the choice, both from positive and negative sides. Our investment thesis is to hold the stock. As we last checked on April the 21st, the price of the stock was 2.48 New Zealand dollars per share. The price has been fluctuating in the last days, and we predict that the state will keep on in the near future. At the bottom of this page, you can see the main catalysts and risks we'll soon cover in our research.
Now, I want to share you with some statistics of this stock and the company. For example, the company's valuation measures its balance sheet, income statement, profitability, and cash flow statement. The statistics here indeed matters a lot in our following analysis, and more explanation of this part will come later in our valuation part. Then, let's know more about Air New Zealand. Air New Zealand provides global air passenger service and cargo transport service. It has more than 15 million passengers per year. Its current CEO is Christopher Luxon. He has taken this position since 2016 and has 18 years senior leadership experience. From the share structure, we may know that the New Zealand government holds over 50% share of the whole company, which ensures the stability of this company. Air New Zealand has great advantages, not only in its strong leadership management, but also in its unmatched domestic and global network. From the 5-year key operating statistics, we see the numbers of passengers carried increase steadily from 2012 to 2016. In New Zealand domestic and regional, Air New Zealand operates one of the most comprehensive domestic and regional networks in the world, with over 400 flights every day to 21 New Zealand destinations. In Tasman and Pacific Islands region, Air New Zealand operates a huge network to Australia and the Pacific Islands, with 54 flights every day to or from 18 destinations in this region. And this strong network also expands to an international scale, which provides 34 direct flights to 12 international destinations every day. Now, let's take a look at the Air New Zealand wonderful service. It has strong corporate brand and famous Kiwi service culture. Also, it has over 2.2 million members of the Air Points program, which ensures great loyalty and valuable data. The company's modern and highly efficient fleet is also a feature. The company's recent operated aircraft are highly fuel efficient and maintains world-class standards in flight experience. Moreover, Air New Zealand has great network partnerships, which range from simple airline relationship through to deep revenue share air alliance. Now, I want to show you about our analysis towards industry. The airline industry is expected to have reached a cyclical peak in 2016, and its forecast total revenues is $736 billion. And the expected higher oil prices will have the biggest impact on the outlook for 2017. The demand stimulus from low oil prices in 2016 will taper off in 2017 with an increase in jet fuel price and a decrease in speed of growth in traffic. All this will lead to a slower growth in industry capacity. However, negative impact of low load factor expected to be offset by a strengthening of global economic growth, which may help stabilize yields for both cargo and passenger business.
The first catalyst I will describe is the upgrade of the Air New Zealand aircraft. In this March, Air New Zealand has completed the retirement process of Boeing 767s. The company has more future plans to replace the older Boeing 737s with Airbus A320s and retire the Beechcraft 1900s. It's reported that a cabin upgrade would cost Air New Zealand $100 million, mainly spent on its premium seat offering on its B787-9 Dreamliners and its B777-300 fleet. The 3 Dreamliners scheduled to be delivered from October 2017 will already have the new cabin layout, boosting the number of business premier seats from 18 to 27 and the premium economy seats from 21 to 33. The B777s will be put through the refurbishment program, which is scheduled to be finished by the end of 2017. The second catalyst is the continuing growth of tourism of New Zealand. According to the forecast provided by Ministry of Business, Innovation and Employment, the tourism outlook from 2017 to 2022 is very positive. Accompanied with the graphs in the PPT, we have the key messages that visitor arrivals to New Zealand are expected to grow 5.4% a year, reaching 4.5 million visitors in 2022 from 3.1 million in 2015. The number of international visitors is expected to grow strongly in the next couple of years due to the opening of new airline routes and the increase of airline capacity. Also, the international events that will be held in New Zealand would also be a strong stimulation to the tourism. In this page, we only show some of the events that would happen in 2017, ranging from sports to festivals to fashion shows. All these events would attract visitors from around the globe, and as New Zealand is an island country in the Pacific Ocean, the most convenient way to travel here would be by plane. Now, with the catalyst manifested, I'm going to talk about the risks Air New Zealand is facing in the future. The first risk is the very key factor to the airline companies, the oil price. As we compare the prices of international crude oil and Air New Zealand stock on Yahoo New Zealand, it's very clearly shown here that the two prices are of negative correlation. Whenever the oil price rose, stock price would fall. Whenever the oil price fell, the stock price would rise. As Sky presented before, the crude oil price is expected to rise in the future. In this page, there are more graphs about the crude oil price. With the information gathered, it's also shown that oil price would most possibly rise, hence becoming a negative signal for the airline stocks just like Air New Zealand. According to the report from Simply Wall Street, neither the past growth rate or the estimated future growth rate of the company is positive. Also, in this page, we can see that the estimated revenue and profit rates are shown to have no obvious increase in the future. And the price-to-earnings ratio is predicted to decrease constantly for the next years. This fairly bad condition may drive the investors out, causing the stock price to fall. The pictures on this page show more information. We can see that during the last fiscal year, insiders of Air New Zealand have sold more shares than they have bought, which shows a lack of confidence towards the stock. Also, the company's debt level compared to net worth has increased over the past 5 years, which is an unpleasing signal to investors. In the middle of the bottom graph, we can find that the company is currently having a negative PEG number. This also indicates that the state of the company is not ideal. The second risk is the peer competition. An international airline company, Air New Zealand, provides both global and domestic flights, and both sides are being challenged quite much. It can be seen that Air New Zealand is currently facing an increasingly competitive market. Thus, how the company reacts to the signals may be vital to its growth and sustainability. According to Mr. Luxon, the Chief Executive Officer of Air New Zealand, The airline responded swiftly by adjusting its capacity plans and accelerating the exit of older aircraft. These meanings helped the company gain the second highest result for an interim period in the airline's history, but still, the net profit is sharply lower. From the graphs and data Air New Zealand provided in its interim report and annual financial results, we can see again that the earnings have had a huge increase in 2016, reaching its highest peak. Thus, in 2017, the decrease in revenue and net profits are almost certain. We listed the basic data of Air New Zealand and its main competitors in this table here. The first 4 companies include the major airline companies in North America and Asia. The next 3 companies which are shown in both fonts are some main airlines in Australia: Qantas Airways, Virgin Australia, and Airworks Limited. More specifically, we calculated the mean value of every type of data of the 3 companies to gain a clearer comparison with that of Air New Zealand. We noticed that Air New Zealand has the relatively lowest revenue growth rate of the nearest quarter year and the lowest enterprise value to earnings before interest, tax, depreciation, and amortization ratio, being -4.2% and 3.72% respectively. The first number would suggest that the company is developing slower in the industry. However, the latter number would indicate that the company has a rather strong cash flow. Now we get to the final section of the valuation. Here we list some of the key statistics that could indicate or be calculated to indicate the future state of the company. The table here is divided into 2 main parts, the first being the calculations of the enterprise value, as we used market capitalization plus debt plus minority interest and then minus total cash to calculate the number. The second part is more important, as we needed to calculate the equity value per share as an indicator of the stock's future price. As we used the discount rate of 8.55%, we were able to calculate the terminal value through adding the future cash flow and the product of the future cash flow and the growth rate. We divided the sum then by the difference between the discount rate and the growth rate, which would be then 144.96 times 1.028 divided by 5.8%. The answer was then converted back into present value, which is shown here as 17.06 million New Zealand dollars in the table. Then we added the present value of future cash flow to the terminal value to get the equity value. The equity price per share would be then the quotient of the equity value and the shares outstanding. We can see that the equity price per share we got is 2.24 New Zealand dollars, lower than the stock's current price 2.48 New Zealand dollars per share. Although with the catalyst we provided previously, it's possible that in the short run with the push of economy, tourism, and adjustments of the company itself, the stock's still going to have a limited price rise with fluctuations. In the long run, it's more possible that the stock price would fall, since the oil price is forecast to be higher and the future performance of the company is not offering a much optimistic outlook. In conclusion, our suggestion of this stock would be to hold now because of its risk versus reward characteristics. The catalysts and the risks will have the similar impacts on the company, and thus cause the stock price to fluctuate around the current price for a period of time.